Welcome to Qualified Opinions, where we test the ideas and limits, the knowns and known unknowns around freedom and order in contemporary politics and society. We invite you to listen as we engage with leading and emerging thinkers across disciplines and issues who will sharpen our thinking on the topics shaping our discourse. Welcome back. Today's conversation sits at the intersection of monetary policy, fiscal responsibility, and the fragile architecture of American economic governance. I'm joined by two of the most thoughtful voices on these issues. John Cochrane, a senior fellow at the Hoover Institution and author of the Grumpy Economist Substack, and Tom Hoenig, my colleague here at the Mercatus Center, but also the former president of the Kansas City Fed and vice chair of the FDIC, whose warnings about quantitative easing, debt monetization, and fiscal fragility have proven uncomfortably prescient. Central bank independence is back in the headlines. President Trump is pressuring the Fed to lower rates and even threatening to fire governors. Commentators are panicking, but John reminds us that independence isn't an absolute virtue. It exists only within democratic constraint, as long as the Fed sticks to a clear, limited mandate. What is this mandate, though? Tom talks a lot about this in his writing. He also warned that the Fed's own choices, like entrenching QE and expanding its balance sheet and suppressing interest rates, have blurred the line between monetary and fiscal policy. Congress now has a credit card with no limit, and the Fed has become not just the fire department, but sometimes the fire marshal and even the arsonist. So today we're asking big questions. Can the Fed stay independent in the world of chronic deficit, rising debt, and political pressure to keep borrowing cheap, or has fiscal dominance already taken hold? It's a conversation about institution, incentives, credibility, and the future of the American economic model. Let's dive in. So let's dive into this. You guys were talking both at the Central Bank Independence in Practice conference on Halloween, October 31st, a few weeks ago, put together by the Peterson Institute. And I'm biased, but I thought your talks were just actually the most interesting, and in part because I think you were the only two who actually dared to say what either no one is thinking but should, and or no one wants to say about the fact that actually independence may not be everything it's been out, like people make it out to be. So let's start with a broad question for either of you. Fed independence. What does it mean? What's the history? It's a broad question. You can take it wherever you want. Let's start with you, John.
Oh gosh, well, so much for the rest of the hour, huh?
I'm fine with that. You can just make your conversation.
I think you're right, because it's important. Which Tom's speech was just brilliant at Peterson, by the way. Tom, you did a great job.
I agree. The feeling's mutual, John.
Because there was a lot of feeling of clutching your pearls. Oh no,
yeah.
Independence. In fact, I was amused. I chose not to use the metaphor, but I noticed half of the other speakers did use the metaphor. So, just what is so important. You got to think from first principles. And as I started thinking about it, the independence is not an absolute virtue. We do not set things up by saying, dear Veronique, you are now chair of the Fed. Print money, do whatever you want, and we can't tell you to stop or fire you. That's not the way things work in a democracy, and that's not the way things work in the Fed. Independence is a very limited grant, and it comes in return for obeying strict limits. You can only be independent in a democracy if you stay in your lane, and the Fed's lane is inflation and employment, which means nothing else. You can't go after inequality or climate change or reshoring manufacturing or making America great again. That's not your job. You're not allowed to print money for that sort of stuff.
Or climate, yeah.
And as I thought about the functions of independence, why do we have independence? Well, it's not just for insulate the Fed from political pressure. That's number one reason people give. But wait a minute. The Treasury faces political pressure. Politicians are very tempted to hand out stimulus checks and forgive student loans ahead of elections. We don't put that in an independent Treasury who can, tax and spend as they see fit. So what's going on? So independence is there for Fed for a reason. And the reason is a pre-commitment. It's a part of a package that tries to keep the government from goosing the economy now, which will have bad effects later. And most importantly, and you look at the history of independence, it's not really about this Phillips curve and so forth. The main point of an independent central bank with a limited mandate is to avoid the temptation to print money to get out of bad deficits, which is the problem facing the U.S. right now. It's a pre-commitment that we will pay back our debts. We will not, in the end, inflate them away. That's the point of independence. And as I thought about it, of the package, the independence of the bankers is less important than the rules, the limitations, I'm sorry, I'm not allowed to print money. And so as I thought through what do we do, given the problems we see, that restoring the limited mandate of the Fed is more important than just the independence, which was at the end of the conference, there was some pro-clunching, but at the end, it was kind of a ships on deck chairs on the Titanic exercise of just, who gets to fire who, when, I don't know, that didn't seem that important. Now, what I left out here was the problems. We're here because the Fed has failed in many ways and exceeded its authority and led to people like me and Tom were saying for years, you keep doing this, your independence is going to be in question. And here we are. So I didn't say any of that because Tom was so good at it. I want him to tell us about everything that went wrong and is now questioning the Fed's independence.
Tom, please, so tell us two things that I think is important. Is we've been there before, and you pointed out in your writing, but also I think in your talk about the time where it happened before in recent history, in 51, what they did to try to actually address this, but also tell us, jump on what John said and talk about actually all the ways where maybe kind of the Fed has taken its mandate and kind of stretched it to the point where we're in trouble right now.
Well, first of all, let me say that I think of independence, one of the main reasons for it, and John touched on it as well, that Congress knew when they were delegating their authority away to the Fed that one of the things they wanted to do is recognize that when you are spending money, you also like to print money, so it's easier to spend. And so they put the Fed outside, and they said it was structured to be independent so that it could say no to the desires of Congress to print money to cover their deficit so they could spend more. And what I find very difficult to understand is the Fed's reluctance to follow that one very important, in my view, mandate. That is to say no when they're running huge deficits and want the Fed to monetize it. And what happened was, through their interpretation of independence, the Fed's interpretation of independence, it could do pretty much what it wanted. So in 2010, when they began what I call the ongoing quantitative easing, large asset purchases, they began to buy government debt in mass, and they were teaching the Congress something new. That is, we can buy all the debt you can print if you really want us to, and right now we're willing to do that, so let's do it, and we'll keep interest rates zero so the cost of your debt will stay low. And that became the mandate. A perverse kind of a mandate. And so they carried that forward, and Powell picked up on it from there. And with the pandemic and the enormous fiscal spending that followed that, the Fed printed money to accommodate, keep interest rates low. And as a result, we got, and I argued all the way that we got inflation, and inflation included asset inflation. It's not just consumer price that you're looking at. And so they violated their primary mandate. So it's not just I found it silly for them to be getting into to global warming and all that, because it was at the time in their political interest. They really now refuse to talk about their primary mandate. If you ask the current chairman about fiscal policy and the deficit, he said, "Well, that's not my bailiwick." Well, Volcker knew better, and he said, "If you keep doing this, I've got to restrict how much reserves, how much of this I buy, and you'll create a crisis," which they did. So we need the Fed, if it's really carrying its mandate out, has to say to Congress, we need to talk with the Treasury, and we need to agree that we're not going to expand reserves without limit. The economy can grow at best 3 to 4% a year. We may increase our reserves by that much, but we're not going to be buying massive amounts of debt, and you need to know that now. And if you do, interest rates are going to go up. Because let me just go back one last thing. If you go back to Volcker, when he finally came in, we're going to address inflation. He didn't say, "I'm raising rates to 20%. He said, "We're going to constrain the growth in bank reserves." And then the follow-up on that was interest rates jumped to 20% until they learned. And so that's, to me, independence is having that dialogue, saying, "Here's my primary mandate. You gave it to me, and we're going to follow it." And that's something for precision to do.
I just want to emphasize what Tom is saying here, because it is what I learned from this conference and thinking about it. When we talk about independence now, the story that gets told is, Nixon leaned on Arthur Burns to goose the economy to win the election, and Burns gave in. So that's a story about Phillips curves. It's a story about small goosing of the economy, a little inflation now in return for less unemployment. That is not the issue historically, and that's not the issue going forward. The issue historically, by which central banks were set up to be independent, is precisely this one of pre-committing, we're not going to inflate away your debts. And when you get into deficit trouble and you don't want to raise taxes and you don't want to cut spending, and you come to us to print some money to tide you over and to hold down interest rates to make the interest costs on the debt seem lower, we're not going to do it.
That's the Fed-Treasury Accord of 1951, right?
It's the accord, but it's the founding of the Bank of England. It is the heart of the central banks of Europe after the hyperinflations. That is the crucial thing. Now, there are exceptions. This is the hard. First of all, think of how hard that's going to be when you're facing a real fiscal situation, like the government and the Fed thought that 2021 was like a war. It was and in a war, what do? You spend money like crazy. You tell the Fed, "I don't want to hear it. Print the money. We're going to win World War II. I don't care if there's some inflation, and hold interest rates down." That's exactly what our government did in World War II. We got inflation out of it after World War II, and arguably, you don't want to lose World War II on the altar of no inflation. So this is not as easy as it sounds. And now, we're not going to be fighting World War II. We're going to be running into the great, it's sort of Latin American finance. That's where we're headed. We have spending and social programs we don't want to cut. We don't want to pay for them. And we're going to lean on the Fed to hold interest rates down and to print it up. So is this World War II where you give it and you inflate? Or is this the way to becoming Venezuela where you don't? It's not going to be easy. And what Tom said is really important. You need this comes from Congress in the end. Congress is the one who says, the Fed, you are independent. Here's what we want you to do. You're kind of like the Christmas savings club. We don't want you to, save us from ourselves. But Congress has to be pretty clear. No, we don't want you inflating in those situations. The Congress, of course, not at all clear about that right now.
And so, if I can point two things that you said. So the issue after the war, it wasn't so much that inflation resulted in all that printing and the spending in the war. It was more that they were going to continue putting on the pressure on the Fed, right, to not actually fight. Basically, they weren't letting them fight the inflation, which, in the coming out of an emergency, you should kind of implement austerity. You should fight inflation if necessary, right?
Daryl, coming out, look, in World War II, what the Fed did with the Accord was reestablish the boundaries, reestablish its independence.
Yeah, because they weren't, but it was right. 51, so it means that they must have been like 7 years, right? No, it's not 7 years, so it's like 6 years or whatever, where they were under pressure to actually not fight the inflation.
To keep interest rates low so that the cost of the debt would remain low. Just some of the pressures you see today. And you can do that, but you're going to get inflation worse. And they knew that. And they were willing to talk about it, and they were willing to challenge the Treasury. The difference with this Fed is it's not challenging the Treasury. It's not saying we can't peg your rates for you, keep them low as they're insisting they do. They're saying, okay, we're thinking about it. And what bothers me is this last meeting where they're talking about ending QT, and now quickly the discussions are turning to reestablishing some form of asset purchase, another form of QE. The president of the New York Fed just did it. So they're not, for some reason, they still have not accepted what their mandate is. And that's going to lead to, I think, big problems down the road as they monetize the debt.
So
I'm a little more a little more charitable. The Fed's intellectual framework remains the Phillips curve, and they think entirely in terms of inflation-employment trade-offs, and they view themselves as between a rock and a hard place of Trump wants to goose the economy. They think the labor markets are the big thing they're in charge. Somehow the overnight interest rate has something to do with labor markets, and they have to offset tariffs somehow. They're not thinking about the basic issue. A lot of the pressure from Trump is to lower interest rates, to lower the interest costs on the debt so that the deficit isn't this looming problem for him. And they're not even thinking let alone.
But that's not charitable. That's terrible, isn't it? John, for them not to be able to think past that, it's really upsetting.
Let me ask you this, which is crazy that I actually don't know the answer. So when did the mandate to the unemployment mandate came in? Was this added, or were they always together?
I think it was late 1970s when they put them together, the dual mandate, or actually three mandates: maximum employment, stable prices, and stable long-term interest rate. I think that came in legislation in the late 70s, didn't it, John?
Low long-term rates are part of the mandate.
stable long-term.
What about
You're right. No, it's low long-term interest rates.
Low long-term rates.
Where does
that? Most of us interpret that as low long-term nominal rates, which means keep inflation low.
Right.
But the text of, if you're an originalist, you could say, well, we never really solved that 1951 issue.
Where does the financial stability? I mean, it's not an explicit mandate, but it does seem that the Fed is trying to do this.
Yes, I think part of it was the Dodd-Frank Act had some reference to financial stability, although that was on their agenda beforehand. But I think that made it more explicit, and they've interpreted it to they've interpreted the mandate to say, well, we have to have liquid, readily available market for government securities. The government security must be stable, must remain liquid. And they're reacting to that very quickly in these instances. And I think
let me go. Sorry.
Go ahead.
Let me go just a little deeper there. The Fed was founded, number one, as lender of last resort. So from 1913 on, it's not in the official mandate, but that's and so its legal authority to oversee the banking system has been there since. Dodd-Frank just ratcheted that up one step. So that financial stability has been its mandate forever. But as in other things, it has done what every agency does. That the Rural Electrification Agency steadily increases until somebody says no. And that's what the Fed has done here. When I think financial stability mandate, that is to make sure we don't get in trouble in the first place. So require everybody, you got to have a lot of capital, and because we don't want to be bailing you out. But instead, it's ever larger bailouts is their idea of financial stability, to the point where now in 2020, the Fed said we will not let the price of corporate bonds fall. So now the mark-to-market value of long-term corporate bonds may not fall in a crisis. That means if you're keeping some cash around to buy on the dips, forget it. The Fed's going to front run you. And that's just the tip of the bailout iceberg. What Tom mentioned, yes, if in 2020, Treasury, it was kind of tough. The Treasury market got kind of tough. Now, central banks were established to help a liquid market in government debt. That's what the Bank of England was established for in 1690 or whatever it was. But that doesn't mean that you are essentially the provider of liquidity. What happened is that we won't get into what happened with the ill effects of Dodd-Frank regulation, the monopoly that the dealers' banks have on trading of treasuries. But basically that system fell apart and the Fed jumped in and the Fed started keeping down the price of treasuries. So again, way overstepping what's necessary for that narrow mandate of financial stability.
Well, they're creating an environment that actually is destabilizing because because in anticipation that the Fed will step in, you have these margin players, these hedge funds, playing off the yield, off the basis point yield, and they're speculating and wisely so, because the Fed will come in and bail them out. And that's part of the issue here. And that's what happened in 2019 in that September mess. So, they build the expectation that they're going to come to the rescue, and the market behaves accordingly. And we're buying into.
While Tom froze, I'll get my two cents. This is the central kind of pre-commitment that an independent Fed with a limited mandate is supposed to be there to stop. And it's a central pre-commitment problem. After a crisis, everyone wants to bail out. If we know that the Fed is going to bail out after a crisis, then people borrow too much, don't do any risk management, don't keep any cash around, and the crisis is worse. So the Fed is supposed to pre-commit. We're very limited in how much we do in a crisis, so you better get your ducks in order. But in fact, we're in kind of the opposite one, where everybody knows the Fed will always jump in, and the ECB too, and the Bank of England, they're always. And so we have a much more fragile financial system than we should have.
But so I was going to actually ask you this. It's like, if there are things that we've learned in the 80s, is that expectations matter a lot. And it seems that like people are talking from both sides of their mouth or brain or whatever it is. It's like on one hand, there's this idea that the Fed is credible because it pre-commits. There was the whole forward guidance or whatever. Isn't that kind of a way to kind of anchor expectation? Like I don't know what's hot about this, but it seems that it was like, oh, we're going to keep the expectation. Meanwhile, signaling on the expectation side that we're gonna do all these things that create bad incentives. So how do you kind of force people to think in a consistent way about this essential problem?
Well, I think they are thinking in a consistent way. This is how the Fed behaves, and the Fed has not done anything to change that perception. They've been consistent with it and stepped in every case. It started with Alan Greenspan, where he said, we'll let it go, and when the crisis comes, we'll come in and save the day. And that's been the path ever since. So the Fed's been consistent, and the market's been consistently reacting to that. What it takes is, and you give up the opportunities, we're not going to do that anymore. Let's explain this to you. We're going to have a conversation about printing money, and we're not going to do that anymore. And we're not going to bail out. Now, I agree with John. The lender of last resort was there for solvent institutions who needed liquidity. But we're saying to you, we don't care. You can gamble. We have a standing repo facility that we set up for you. So if you're in the securities market, the Treasury securities market, and you have a liquidity problem, and the cash that you need to support your purchases is drying up, and the rates are going up, and I'm owning this stuff. Well, I'll put it with the Fed, and they'll take care of it for me. But
isn't that a contradiction with? Isn't that a conflict, or making it very hard to pre-commit to keep price stable?
Yes.
Yes.
So I kind of like the standing repo.
This is where I think the contradiction comes in, where they hold these two things together.
I kind of like the standing repo facility, but I don't want to get in a fight about that. I think let's understand, here's the central problem. What we want a central bank to do is to tie itself to the mast, in famous Odysseus. language. In other words, to pre-commit today that you will not do next year things that you will want to do when the time comes. When there's a crisis, you will want to bail out. Tom will bail out. I'll bail out. Veronique will bail out. When the crisis has come, we will want to throw money at it. It's nearly inevitable. And Congress will want us to throw money at it too. Similarly, when the government runs into debt problems, everyone's going to want to paper it over to inflation. So we're trying to set up institutions where we promise today that we won't do that tomorrow, precisely so that people will set up their affairs better today financially, and people will expect low inflation. If people know that we'll meet any crisis with inflation, then they expect higher inflation today. And when they expect higher inflation, then we get higher inflation because people raise their prices now knowing what's coming. So you have to tie yourself to the mast that tomorrow you won't do things you'll want to do when the time comes. Now, let me just summarize the academic literature. Independence alone is not enough. Because the independent Fed will want to bail out just as much as the dependent Fed. The theory of independence alone working specifies that Congress will appoint central bankers who are just ideologically hawks. And we're not seeing that. Congress and the president are not saying, I want to appoint someone who's really just irrationally tough on inflation because that's my pre-commitment. That doesn't work. Then there's the forward guidance is sort of promises. It's, we'll be really good when the time comes, but there's no pre-commitment. It's you're sailing past the sirens. You say, oh, I'll be a good boy. I won't go jump in after the sirens. You don't have to tie my hands to the mast. Just make me independent. Well, that doesn't work because, you float through the straits and you jump off the boat. You have to set things up so that you're not able to do in the future what you'll want to be doing in the future. And that is the only way to truly pre-commit and to get those wonderful benefits that people believe low inflation, that if people start to believe inflation's coming, you won't meet it with just more speeches. You're going to meet it with actions, with threats, with, yes, guys, if inflation comes, we are ready to repeat 1980 if that's what it takes. And you never hear that out of the Fed. It's just, expectations are anchored because we're such good people. Really? What are you going to do about it? Right. And unless you really say what you're going to do about it.
But they have no rule there's no rule that they actually have to follow no matter what. And so there's no ability to give that kind of absolute assurance, as has been proven over and over again. That's why we're in this vicious circle, I think, of, we're going to be tough, but not this time. We'll be tough next time.
And so independence with huge power is not a solution. The solution has to be independence within a limited mandate. And there really is a hard choice. This is where we're at. There's a hard choice facing us. The Fed has expanded and expanded and expanded. It's now much more powerful and deploys a wide set of tools than it did 20 years ago, including, buying buying mortgage-backed securities, buying private assets, floating prices up, bailing out right, left, and center. So those are intensely political actions. One of the limits on the Fed is the Fed shouldn't do things that political agency, it can't raise taxes. You want to stop inflation? Raise taxes. You want to create inflation? Give people money. Fed's not allowed to do that. Why? Well, of course, that's, political. Fed can't do that. But the Fed has expanded into things that are political. So we got a choice. We got either no more independence. It's just a branch of the Treasury, and then it's accountable to the voters, and you get what you get, just like taxes and student loan forgiveness and everything else. Or it's restored to a limited range. That's the only way to be independent is if you stay in your lane.
Yeah, but how do you get them back in their lane, John? That's my. I want to do a chord that gets them back in their lane that has some strength behind it, some assurances behind it, and that's where I'm struggling.
Well, we need that kind of government that we all sort of long for, where there's bipartisan consensus.
Yeah, right.
And Congress is good at writing very. The original Federal Reserve Acts were really kind of beautifully set up. The structure of the Fed is really artfully set up. Those old guys 100 years ago, they maybe not perfect, but they really knew what they were doing. Unfortunately, bipartisan consensus on well-crafted long-term structural bills like immigration, Social Security reform, tax reform. We're not in that moment.
But so like the there are two things I want to bring up. So I got into kind of being aware of the connection between the fiscal and the monetary side in 2021, really. Until then, I was just perfectly happy to try to pretend that I could just like stay in my lane and not look at the other side. But one of the things that I thought was very weird is like during the in 2021 when the what was it called, the American Rescue Plan was passed, I was just kind of like looking at the output gap and like the size of the American Rescue Plan, and I was thinking just from a pure Keynesian type of thing, something just got to give there. Either it means that the multiplier is just really, really, really small, or we're going to get inflation. Like I was like kind of, I was asking my Keynesian friends, like, which one is it, right? And I just, it's that's kind of like the thing that kind of pulled me into that world. But also, what was really getting at me is like everyone was like, just don't worry, if inflation breaks, which people thought wouldn't actually, the Fed has the tool. The Fed has the tool without kind of really actually telling us what these tools were, except that they sounded to be pretty like painful looking back at the 80s. And the other thing is, from a political perspective, and that kind of goes back to the question of political independence of the Fed or independence, is like I was just kind of really annoyed during the pandemic where Chairman Powell was constantly like cheering on more spending. And then after that, he was like, oh, well, Fed independence, I can't tell Congress what to do. And I was thinking, that's bizarre. And everyone seems to be comfortable with that. So you can take this however direction you want.
Well, the first thing I would tell you, is that there's two phrases that always make me wince. And that is, we have the tools. And the second is, this is just insurance. This is an insurance action so that we make sure that we come out of this slowdown readily and so forth. Because the tools, if you have the tools, you should be using them where it's obvious to use them, not say, well, I have them, but if I decide I need to, I'll use them. And the other is insurance. There's a premium on insurance, and we've learned that. It's been a more fragile economy. It's been inflation, and so forth. So, back to John's point. What is the lane that they should be in, and they should be practicing it. And one other thing I'll just out of the blue, and that is forward guidance. I'm very very concerned about forward guidance because it is we're going to do such and such, which means now you're pretty much, you're bound by that, and it causes the Fed to delay actions that they would have otherwise maybe taken. So there's all kinds of things around it, and so you need a clear mandate. Stay in your lane, as John is describing, and stop interpreting your mandate to broader uses. It's this what they've used independence for, which really bothers me, is to interpret their mandate as broadly as they want. That's why you have them buying corporate debt. You have them bailing out municipalities. It is just a very dangerous thing to do when you have the printing press in your control and people coming at you all the time to use it for their own benefit.
Let me make a couple of comments on that. Actually, forward guidance, when they first said it, the idea was we're going to hold interest rates low even if inflation comes, because we want to stimulate the economy today. And I laughed. I said, well, that promise, that's no good. It turned out to be remarkably effective. When inflation came, they did feel bound by it. They held interest rates low, exactly as they had promised. They let inflation come. So to some extent, that was surprisingly effective pre-commitment. I think they're sorry about it now. So I think I agree with you in the result. So looking back at 2020, it was very interesting. Yes, even Larry Summers just took his IS and LM curve and says, here comes inflation. But the Fed did not see this as monetizing debt. They saw it in traditional terms. And I think a lot of the mistake was in that traditional Keynesian mindset. They looked at COVID and saw I forgot, GDP fell 25%, unemployment was out of the roof. And they said, oh my God, this is the Great Depression. The Fed, in this Keynesian mindset, all fluctuations in output is always demand. So you're having 25% unemployment because people don't have enough money to buy things. So we'll give them money to buy things. No,
Yeah.
the economy's closed because there's a raging pandemic out there, and you locked it down. It was I call it snowstorm. In a snowstorm, there's neither supply nor demand, but it's not, you don't need to give people money to clear the snow. You just need to wait for it to melt, and then the economy will jump back as it did. That was the first big conceptual mistake, seeing this as a lack of aggregate demand that needed to be full. And remember also the zeitgeist at the moment. It was R less than G, modern monetary theory, secular stagnation, savings gluts, don't worry about government debt. There's an endless supply of government debt. So that they were not thinking. And it will never go
away. And it will never
go away. It's an infinite flat supply for good. They were not thinking we're going to do war finance. It was war finance. We're going to do this like World War II, print money. So what about the inflation? They weren't thinking about that. They were thinking in those terms of endless supply of government debt. Now, they were following policies that in the Revolutionary War, Civil War, World War I, World War II, Vietnam, Korea, all created inflation. But they were thinking in those sort of Keynesian stimulus terms. And the last thought on this, the independents, is what Tom pointed out, they don't talk, they say now we won't talk about fiscal policy. Of course, the Fed was very happy to talk about fiscal policy when it said we want more fiscal stimulus.
Yeah.
They're just never happy to go out and say we want fiscal restraint. Now, to some extent, this is justified because the separation is the Fed isn't supposed to do fiscal policy because fiscal policy is political. You need an accountable treasury to do fiscal policy, which they remember when it's convenient to remember.
Exactly. It's they're inconsistent on that front.
The current doctrine of independence grew out of a time when fiscal constraints weren't really important. In the 1970s, debt to GDP ratio was relatively low. 25. It was about the Phillips curve and so forth. You could say monetary policy can do what it does independently of fiscal things. Yeah. But we're now back in a 1948 debt to GDP ratio where you just can't ignore that monetary and fiscal policy have interactions with each other. So that makes it very hard for independents. They have to be able to face this issue. Will you print money to finance deficits?
Yeah. But John, I worry that we can recognize it when it's massive, but it happens on the margin. I mean, it's like today. You look at the repo rate; it's above the Fed funds rate, or it was, and you say, well, if that's what you were targeting, you'd bring that back down. But what you're doing to do that, you have to do open market operations, so you buy more debt, and on the margin, it kind of creeps up on you, and next thing you know, you've got inflation. You've monetized it as the excess demand for the excess supply of government debt is there, and you need a buyer, and you're the marginal buyer, and you bring it in. It just seeps away at you. And I don't agree that the Fed should not be talking about it. That it is separate from fiscal. In this sense, if they are going to spend more, if they are going to create deficit, you have an obligation as a central bank to say that's fine, but we are not going to monetize it because that's why we were so-called independently set up. And you have to communicate that. Volcker communicated that. Others have. The 51 Accord communicated that. Yes, you can do what you want to do, but we're not going to monetize it. That's talking fiscal policy, but responsibly so. That's what I'm pushing them to do.
This is a good transition to talking about fiscal dominance. And I think you both have hinted at it in various ways. So people talk about the president's putting pressure on the Fed to lower interest rates in the name of lowering interest payment on the debt. That is like textbook fiscal dominance. But one of the things I've been trying to express to people when talking to them about this is that actually, even when Trump is out of office, we're going to continue to suffer from fiscal dominance. And that will continue as long as Congress doesn't basically back all that debt. And in part, it's because of like we're seeing it right now, like any increase in interest rates materializes immediately in higher interest payment, which would require actually the fiscal side to do some fiscal adjustment in order to accommodate these increased interest payment. Instead, we're not doing this at all. So, but it's like the fiscal dominance is not going away no matter who's in office if Congress doesn't finally, do something.
I mean, I agree with you. Fiscal dominance is actually gaining because the choices are let interest rates rise or print money.
So do you think people at the Fed understand that they're in a place of fiscal dominance that is not going to go away no matter who is in office? Ultimately, as long as Congress behaves the way Congress behaves, it is putting the Fed in a position where, it's going to have to, I don't know if it's going to have to, but it's putting it certainly in a very, very difficult position because there's no economic independence. The fiscal and monetary interaction at this level of debt to GDP ratio is just like overwhelming.
Well, I think the Fed's in denial. I mean, they keep, at least they're on the surface, they're saying, there's no fiscal dominance. We're doing our job on a day-to-day basis. But I think, I think their choice is either let interest rates rise or print money. That's where they are. And if they do the latter, then they've succumbed to fiscal dominance.
I would.
Fiscal theory of the price level.
I read it, John. I read it.
Yes, we have read it.
I just, held up
for those who don't see, exactly. For those who don't see, it's John just raised his book, which came out.
Okay, John, bring it down.
The timing was like amazing. Like you put out a book on inflation right at the time where inflation was, for the first time in over 30 years, a debate again. Meanwhile, Olivier Blanchard, who's the head of the IMF, put out a book on how we just actually shouldn't worry because interest rates were like really, as long as interest rates were low, which everyone assumed would stay forever, and were lower than growth rates, we were fine.
So I got on timing. I got lucky. I thought I was going to write this book in 2005, and I'm just lazy. So laziness paid off, and it came out at the right time. So I held it up just to, I think we're always in fiscal dominance. It's just, more or less. The problem is going to be, let's just think about how hard it is. When you set up an independent central bank and you want to use it to stop a fiscal inflation, you're setting up a situation where the government is really in trouble and says to the central bank, we want you to hold interest rates down. We want you to use all the tools of financial repression, force banks to hold government bonds, force insurance companies to hold government bonds, capital controls if necessary, whatever it takes to increase demand for government debt because we're having trouble now. And you're wanting that central bank to say no. And, it may seem like a crisis. In fact, the central bank's tool what you're saying is you want the central bank to say no, and therefore the government must face the fiscal problem and raise and stop the spending problem. It's about the long-term spending problem. It's not about today's austerity. You want to, solve the Social Security, get the government to a point that people are willing to trust that not today the deficit is over, but that we will go back to, in 5-10 years, a sensible fiscal policy that I'm willing to hold government debt. So the central bank's refusal says basically, you guys either got to raise taxes, cut spending, or default.
But in the short term,
it's really hard for a central bank to say that.
But austerity does still matter in the short term to fight when the central bank is fighting inflation and is raising interest rates precisely because of the impact on interest payment, right?
Well, not necessarily. So interest rates will be low. Long-term interest rates will be low if people have faith that their debt will get paid back in the long run. And so, you look at the great ends of hyperinflation, at the end of the German hyperinflation. They solved the long-run fiscal problem, and the government was able to borrow more in the short run because people had faith in its debt. So it's really about solving that long-run fiscal problem. Short-term austerity tends to make, it usually means raising marginal tax rates with the current Swiss cheese of a tax code. And that kills the economy. And now you got to have more bailouts and unemployment benefits. So the whole thing spirals.
Well, if you understand the austerity literature properly, you know that fiscal adjustment should be based on spending, not on taxes, because that's the only way to actually properly reduce the debt to GDP ratio. But
so we're focusing too much on the Fed's job is to wait for the crisis to come and then be tough. No, the Fed's job is to make it very clear ahead of time that that's what's going to happen. So you fix your fiscal problem today. That the point is a pre-commitment. This is not there. It's sort of like Greece joining the euro. That was a pre-commitment to, we can't just inflate and devalue the drachma. So we're going to be forced to repay our debts. It didn't work out so well, but that's the idea.
But I worry about, I think we're still in the midst of fiscal dominance, and it's coming forward because if you look at the other actions that the central bank is taking, they've dropped all reserve requirements. That's to allow you to lever up more, and they're easing the capital requirements that people say are strict, but they're easing them because otherwise that's a constraint on holding assets, especially government debt. So everything they're doing is to accommodate the ability to get the asset holdings on the bank's books and others up because you have this massive debt.
And this is, the ECB is even worse than the Fed about this. Anytime a sovereign spread starts to bump up, 20 basis points, they go, oh, fragmentation, dislocation, dysfunctional markets. We must buy.
We must get
keep the interest rates down. Yeah. So functionally, we're keeping those interest rates down and financing deficits.
By the way, this is a good moment for you, John, to plug your EU book, which is absolutely excellent. Really so good. Crisis Cycle. It is so good. I got it immediately. I pre-ordered it and I got it immediately. And I learned so much also about the history and what is dysfunctional. And so do you want to talk a little bit about this?
Oh, well, I'll give you the 5-second version. You think the U.S. Fed has problems. The ECB has worse problems. The ECB, and a little bit, the ECB is a case of, I think, actually a central bank that's too independent. The Fed's independence is limited. They have to, be reappointed by Congress and appointed by the president, confirmed by Congress. They have to report to Congress. Yeah. They face very powerful political actors who sometimes say, we want you to goose the economy, but sometimes say, what the heck are you doing here? The ECB is the European Union, Ursula von der Leyen or whatever. It's a very weak political oversight. And they are much more formally independent. So when Christine Lagarde decides, I want to go save the climate, there is no one to say no.
Yeah, and by the way, and talking about extensive mandate, I heard yesterday, I saw this on Twitter, that the head of the ECB just gave a talk about how they were going to fight misinformation. And I was thinking, what? Is that your job? It's like crazy.
Yeah, this is, we're sort of witnessing the end of the progressive era in the 1920s sense. The idea that we'll just give PhD credentialed technocrats, put them up in a beautiful office in Frankfurt and let them do whatever they want without any political accountability. That's been failing right, left, and center. And that's kind of the structure of the ECB.
And it shows.
By the way, can I just add something about like the talking points I've heard a lot about political independence of the Fed? I always thought this was a weird case to make. While yes, we don't want the president pressuring the Fed to do things that it feels it shouldn't do, there's no real political independence, or actually absolute political independence, because the Fed was created, by Congress. The chairs are appointed by the president. The Fed chair has to appear before Congress, so it's not. It's more of a norm than, and the problem is we live in an era where actually fiscal norms and all these norms that used to hold everything together and we didn't actually appreciate are going poof, and how do you put the cat back in the box? But I always thought that the conversation about around political independence is weird.
Yeah, it was a norm, and norms are good things to have, not just rules, because people break those. You're exactly right. It's part of the norms breaking down, but it's also, it's not an absolute good. The Treasury isn't independent.
Yeah.
The SEC isn't independent. So everything lies on an appropriate spectrum.
So before we finish, I want to ask you about, like, if you had the power to fix the Fed, what would you do? What institution would you change, or like maybe what lessons would you want to actually the Fed chairman or the people? I mean, it's more than him to have the power to learn. What is it that they either don't know, need to have? You can take this in whatever direction, but I would actually really love if you could expand a little on, like, kind of what is it that they should know that they don't know, or what is it in their belief that they need to correct that would kind of be an important step in fixing these problems?
Well, let me just, because I don't have a lot of ideas, I think John does, but number one is, I think the Fed there needs to be some kind of a judgment about what's substantive and what's a major change. For example, in a crisis, that you can act, you can print money, you can provide it, but it should be limited in time. Yes, you can do this 6 months. You can do QE for whatever period, and if you want to do it beyond that, then you have to go to Congress and get a law passed to do it. That really puts restrictions on them that in the moment, and it puts responsibility back on the party that it belongs, that is the Congress. If they want to blow it up, then it's theirs to be responsible for, rather than this behind the door and you have the meeting and a wink and a nod and they go off and they do QE for 5 years and blow the balance sheet up. Congress was never involved in that. There should have been a requirement after the crisis, which was clearly marked by 2010, we're going to do this. Now we have to get permission. I think that's essential. Put responsibility back into the Congress.
I learned reading you, Tom, which I didn't realize, because again, I was really very happy never paying attention to the Fed and to monetary policy, that actually didn't realize that the 2% inflation target was, I mean,
purely arbitrary.
They came up with it like poof, on their own, and right. They did all these things on their own. So,
yep.
So let me. It's a other than they should read the Fiscal Theory of the Price Level.
Yes.
I want to emphasize the people at the Fed are great. This is not a story of dumb people, bad people, uneducated people. It's probably the most competent economic institution we have in the federal government. We are all economists. We don't locate problems in the good people and the bad people. We locate problems in the rules of the game. And these are great people subject to some rules of the game that need fixing. And, I'm not sure I could have done better in the heat of battle. So, the rules of the game need fixing. Congress needs to step up, and we need a much more serious limited mandate. I would say exactly what Tom said. Congress said price stability, but let the Fed define what price stability means. Now, I think Congress meant price stability. They meant price stability. They didn't mean 2% inflation forever, and 2% inflation on an aspirational basis. 2% inflation, but we forget all of our past mistakes. If it hit 10, oh well, don't worry. So long as the forecast says 2, we're okay. I don't think that's what Congress meant. And the inflation targeting countries led us on this. I think, Congress needs to decide what price stability means. I would encourage Congress to say price stability means price stability. The CPI shall be 320 forevermore. And if it gets up, the Fed is supposed to bring it back. And if it brings down, the Fed is supposed to bring it up, and we'll do our part too. So that, inflation target, price level target needs to be quantitative, accountable, measurable, and that's the only target. Forget about, employment will take care of itself if you take care of inflation. Don't try to do too many things at one time or you do them badly. simulate financial stability, we need way more capital, burn Dodd-Frank, and the deal. You just, don't try to do the impossible. We saw with Silicon Valley Bank. This was just a classic example. We have hundreds of thousands of pages of Dodd-Frank rules, armies of regulators and supervisors. They could not see plain vanilla long-term treasuries as a risky assets. This is a herd of elephants in the room, and they're trying to see climate risk to the financial system, but they cannot see, that just tells you that whole system is gone.
Well, that was actually, I put it on the back also of those who have said that interest rates would always stay low. Always, always, never worry. Like, there's just that's always been.
Yeah.
It's a mistake.
And I agree with it. Now, in a crisis, you do what you got to do. But let's, there need to be strong limits. Now, temporary, the Fed needs to jump in sometime, but where there's credit risk, where there's other stuff, get that stuff off to the Treasury, who couldn't take the responsibility. Bailouts should be, the Treasury takes responsibility. And one of the good things we saw in 2008, the TARP, the whole idea was I think, silly, but Congress had set rules that limited what the Fed could do. Congress said there is a crisis in hand. The rules are suspended, and therefore we take responsibility for what happens afterwards. That's the right way to go with crisis powers.
Right. And I would say the Fed, others in a crisis usually do perform very well. It's getting out of the special actions that you've taken that was the hard part, and that's where you need to go back and say, I can't do this anymore. You have to give me permission if you really want it.
Cleaning up the moral hazard in between the crisis is the central thing we're not good at.
And it seems also that kind of actually have a definition about what a crisis is. Like we're like in the fiscal space, and it seems all over the place, we have a problem with actually knowing what an emergency really is.
Let me just add this. I read the Dodd-Frank Act and I searched it. It never defines what systemic risk means. And it has now become, in the Fed's mind, systemic risk means someone somewhere might lose money on some unwise investment. No, systemic crisis is a systemic run, period, full stop, nothing else. And it's a problem of liabilities, not a problem of assets.
Yeah, we know when a serious crisis occurs. We just don't know when a modest crisis is now becoming a serious crisis, because we don't want the markets disrupted. And that's what we've come to.
Yeah. Some market somewhere goes down in value. That's a crisis.
Right.
Well, at the end of this conversation, though, John, I take your point that there are fabulous people at the Fed. I come out thinking, man, do I wish you guys were the rulers and the tyrants of the Fed, because I do think that there are things that they would learn if they read the Fiscal Theory, and we need like a shift of mindset. So, thank you so much for talking about Fed independence and not so independence, and thank you.
Been good to be with you. Thanks, John. Thanks, Vero. It's been a lot of fun.
Thanks, Vero. Thanks, Tom. It's been great.